Welcome back, everyone. As we start off in September, the market's falling, and it's falling rather quickly. Nvidia is now down 7.5% on the day. This brings it to a 3-week low. Meta's down 1.5%, Apple's down 2.3%, Netflix is down 3.24%, Google's down 2.81%, and on and on and on. A lot of the best companies, the market leaders, are having a big red day. They're starting to fall. And that brings us into September. September is historically the worst month in the US stock market. The market typically goes down in September, and based off the start today, it seems like this month is going to hold up to that reputation. But why does the US stock market typically sell off in September? We'll be looking through some of the reasons, some of the catalysts causing the market to sell off. In fact, the market is so questionable that even Tom Lee, the so-called perma bull himself, is giving a bit of caution. He went on to CNBC and explained that the market may go down over the next couple of weeks. It may go down nearly 7 to 10%. He says what he's going to be doing if that's the case and what he'll be advising his clients if we get a nice dip. So we'll be discussing all of this, what the market does in September, what Tom Lee advises, and what I'm doing with my portfolio. Now, we also have some other news to get to. The Level CEO person created an ETF called the deadlift ETF, which it holds only companies with CEOs that lift weights or do fighting sports, non-cardio. Now, with this ETF, he's measured the performance of it over the past couple of years, and it has beat the market by a long shot. It's just crushed the S&P 500. Which companies are in this ETF, and why are CEOs that do deadlifts outperforming the market? We'll be taking a look at that. We also have some saddening news. A lady that was 60 years old was working at Wells Fargo. She died at her desk at the job, and it took them 4 days to realize she was dead. We'll be taking a look at the full account here and some of the illustrations this gives us about work in general. And then finally, Costco prices are going up, and I'll show you the single indicator that I'll be watching to show if these price increases are working or not. So we have a lot to cover in this episode. Let's go ahead and jump in. We'll start off with the main story, which is of course the markets going down to start off September. This is something that is more routine than we'd like it to be. Apparently September is a bad month for the US stock market, and there are some reasons why. It's not totally random. We can look at some of the data and the driving factors for the market in September. History suggests that September is the worst month of the year in terms of stock market performance. The S&P 500 has generated, on average, a decline of 1.2% and finished higher only 44% of the time, dating back to 1928. Now, that's remarkable because over time, the average is that the market goes up. So the market on average is going up every single year, 7 to 10%. But then we have September. September, not only does the market not go up, but it literally goes down 1.2% on average. Now, this also isn't specific to the S&P 500. Even looking at the Dow Jones and the NASDAQ composite, so even the QQQ, both of them on average have red months in September. The average loss of the Dow Jones is 1.1%. The average loss of the NASDAQ is 0.9%. So both of these indexes indicate that we could have a lackluster performance in the month of September. Now, of course, we don't know exactly what causes this lackluster performance in September. Maybe it's just random odds, or maybe there's some driving factors. They do explain that there are some things that could contribute to the poor performance in September. The summer vacation cycle ends in September, and people go back to their desks to trade stocks. Again, in fact, September is the second highest month of trading volume of the whole year. So this could be one of the factors causing lackluster performance, that people trade more frequently. What do we know about trading frequently? People that make lots of trades in and out of their portfolio, do they get higher returns or worse returns? Of course, they get lower returns. When people actively trade, that means they're doing a lot of selling. So the fact that people are now back from vacation, they're now back in the work grind, they're now doing a lot of trading, could be an indicator or a reason of why this month is difficult. Trading volume usually remains light in the summer months, with July and August on average seeing the lowest number of shares changing hands on the New York Stock Exchange, according to FactSet data. So when people are in the summer months and they're going on vacation, they're going on trips, they're not paying attention to their brokerage. They just have their 401k feeding it money every 2 weeks. They're adding to their routine deposits, but they're not doing a lot of active trading. So the summer months, the market's going up. It's not having a lot of volatility. And then we get into September. More trading activity can lead to more volatility in the stock market. Investors look at the gains they made during the summer and they want to reposition their portfolios after a period of returns that maybe look a little outsized. So a lot of people are looking at their portfolios and they're like, wow, I'm up big on this company or that company. It might be time to take some gains, and that gain taking may happen in September. If people have been away and they haven't done as much trading as usual throughout the summer, they come back in September and realize that they've got a bunch of gains in their equity portion. You could see a lot of people taking some gains in September just to get their positions in the right place. So a simple explanation of why the month of September is so difficult may just be human behavior. Maybe we're all getting back from vacation, we're back into the grind, we're trading more, and higher trading volume leads to higher volatility, which leads to lower returns. That could be it. Now, we also have some other people that have some different opinions on it. Tom Lee, for example, has been bullish on the market for a long period of time, but recently he's having a bit more caution. In fact, in an interview just this morning, he's explaining why he's becoming more cautious.
Calls, some of them even short term, it had to do with positive surprises on inflation. And is that going to be enough from here on out to keep the market headed higher, or have we shifted to growth worries now?
I think there's probably more growth worries in people's minds these days. So the jobs reports and claims seem to have more market reaction. I think that's going to be the case in September as well. I mean, we have the Fed meeting sort of in the middle of the month. But this week is the jobs report. I'm sure there's going to be a lot of focus on that.
He believes the market has shifted from inflation concerns to growth worries, and the growth worries are going to be dependent on the jobs report. And this may become a more challenging market if we have a bad jobs report.
I think investors should be cautious for the next 8 weeks. September.
Next 8 weeks, be cautious.
Yes.
You're not always cautious.
That's right. When the market's been up 7 of the 8 months this year, so we know it's an incredibly strong market. But we also have the September cuts and we have the election, things that'll get people nervous. I think in the next 8 weeks, people get a chance to buy. So I think it's good to be cautious, but just ready to buy that dip.
So he brings up a lot of news events. We have the upcoming jobs report. We have elections, which cause a little bit of uncertainty. And of course, we have the market data that of this year, 7 out of the 8 months have been in the green. So we're basically overdue for having a bit of a pullback, or at least a red month. Now, when he's further pressed on this, he shares how much he thinks the market could dip.
How far down? 10%?
I think that 7 to 10 is a possibility. And we've already had 2 7% corrections this year. So it's been testing investors' patience. But I think we should expect turbulence.
And then the question, of course, is when the turbulence comes, is it a buy the dip always? Or is there going to be and by the way, buy the dip at when it goes down by 2 or 3%, or you really actually have to wait for a 5, 6, 7% pullback?
I think 1 or 2 is just almost like daily noise. This market has shown, pullbacks like that. So I think something like a 5% pullback is very likely, but I think we need.
And are you waiting for that?
Yeah, I think it. You know what? We'll find out this jobs report, because if it's too strong and investors worry, and so the stock market's down Friday, I would be buying that dip. But there's a chance that we get a good jobs report and the market's up. I hate to sound so binary, but I would just say at the bottom line is it's a strong market. So I don't think we've seen the top for 2024.
Tom Lee believes the market's going to fall 7 to 10% if we get a bad jobs report, or if we get way too strong of a jobs report and it looks like the Fed is no longer cutting rates. So we have to thread the needle with this jobs report. Not too weak, not too strong. That would be the best outcome. But either way, he says that this market likely hasn't hit its top, not for 2024, and he'll be buying the dip, especially if it's greater than 5%. Now, either way, every reason that I've looked at for the stock market selling off in September is ultimately superficial. It's either because of over trading or concerns about a jobs report, concerns about interest rate cuts, concerns about things that won't really matter in a year or two. We're not going to be looking back in a year and wondering what the jobs report was in September of 2024. Nobody's going to even be talking about that or remember it. These companies are companies. They're businesses that generate a profit every single year. They're going to operate through September and make a bunch of money. Whether or not the tickers go up or down is not that big of a concern. So as far as I'm concerned, with all the hysteria around September and going in from September to October or leading into the elections, none of it is that concerning to me. I look at the fundamentals of each of my companies, and so far, out of all the discussions I see of September, none of it causes me alarm. So as far as I'm concerned, I will also be buying into any dip we can get. If the market trades down 3% or 5% or 10%, I'll be doing greater and greater deposits as the market goes lower. I'll be dipping into my savings. I'll be pulling cash from different places to try to build up holdings as the market declines. And I'll be doing that with both of my portfolios. Now, moving on, one thing that I've always enjoyed in the stock market, specifically with stocks, is making up hypothetical portfolios that have a certain theme, that have a certain element to it. For example, you could make up a portfolio called the Becky ETF, where it has things like Lululemon and Starbucks. You could make a portfolio called the Compounders, which has a bunch of companies that I think will be compounding machines. Or you can make one called the Deadlift ETF, which is one that the Levels.io person made. He says, I made a deadlift ETF with only companies which the CEO lifts weights or does fighting sports, like MMA, and not just cardio. It outperforms the S&P 500 by 140% or 2.4 times over the last 4 years. Lifting weights equals cash. And there we even have the data. The deadlift ETF in the dark blue has far outperformed the S&P 500 in the teal color since 2020. So what are the holdings of this ETF? Well, the first one we have is Meta. And in fact, all of these are equally weighted. So there's not a first or last. These are all the equal weighted companies in the portfolio. We have Meta, which of course Mark Zuckerberg does deadlifts. We've seen pictures of him doing MMA training. So he's a big, he works out a lot. He does a lot of physical activity now. We have Amazon. This is something that I didn't know. I didn't realize that Andy Jassy was doing deadlifts, but apparently he is. We have the Goldman Sachs Group. I didn't know that David Solomon did weight training, but apparently he does. Looks like he's in shape. I've just only ever seen him in a suit. We have the Uber CEO saying that he wakes up early morning and never misses a workout, so that makes sense. We have Microsoft Satya Nadella working out every morning as well. We have Apple's Tim Cook reportedly saying that he does weight training frequently. We have BlackRock's Larry Fink in here. I didn't know that he worked out, but apparently he does. And then of course we have NVIDIA CEO Jensen Huang that also says that he works out on a regular basis, including weight training. And there we have it, the 8 companies comprising the deadlift ETF, all of them led by CEOs that do some weight training. Now, a couple observations about this ETF. The first one is that these are fun to do. I really do like thinking of different random ETFs, especially thematic ones, and thinking about which type of stocks would fit in it. It's a fun exercise to do if you're just wanting to kill some time. But I think more importantly, it shows us that there's a difference between correlation and causation. Now, knowing that each of these companies are led by CEOs that do weight training and each of these companies have performed well may unfortunately cause some people to conclude that deadlifting is a key ingredient of investing in a good company, or that CEOs that deadlift do better than ones that don't. This is a great example of a correlation without a causation, where 2 different events seem like they're happening at the same time, but they're completely unrelated, even though people draw some parallels. It's also an example of being right, but for the wrong reasons, which is another thing that happens frequently in investing. It's the same type of thing when people say, well, a couple years ago, I invested in NVIDIA because Jensen wore a leather jacket. That was the reason I chose that stock. Well, NVIDIA did really well if you invested in it for the past couple of years. Did it do well because Jensen wore a leather jacket? Is that what supports the stock? Well, if you concluded that, you might start investing in different companies where the CEO wears a leather jacket. And you may not have the best outcome if you do that. This is a correlation without a causation. It's being right for the wrong reasons. In terms of exercising, this could also be an example of survivorship bias, meaning that these are companies that have done really well already, and so the CEOs of the company now have ample time to exercise. As they become incredibly successful, they've already made a fortune. All these people have enough money to support themselves for the rest of their life. So now their goal may shift from building their company to taking care of their body. So this is another example of survivorship bias. Or if you look at other companies, especially ones in startup mode, and you're working 70, 80 hours a week, you don't have a lot of time to wake up and do a 3-hour workout. There's simply not enough time in the day if you're just starting a company. Every minute, every bit of effort goes into the company. But when your company's already super successful, massively scaled, now you have a bit more time to have a structured schedule. But I think ultimately, to get better as investors, especially if we're picking out individual companies, we want to be right for the right reasons. It's great for something you own to go up in value, to have a stock price go up, but it's better if it went up because your thesis played out than random luck, because random luck is never sustainable. So when I look at different ETFs like this, although they're fun, and I like the idea of it, I don't think that deadlifting is the key for a stock to go up. And many of these companies like Amazon, that had the founder Jeff Bezos, He was a scrawny weakling as he built that company into the mammoth it is today. He only started getting really jacked, really huge, when the company was already massive. Now moving on, we have a story here that's just sad and a bit dystopian. A 60-year-old Arizona Wells Fargo employee scanned into her office on Friday on what appeared to be an ordinary workday. Then 4 days later, she was found dead in her cubicle. She had last scanned into the building at 7 a.m. Friday, and there was no further scans in or out of the office, authorities said. An employee who spoke with the news on the condition of anonymity said that the colleague found her at the desk walking around the building and that several people had smelled a foul odor, but believed it to be faulty plumbing. Wells Fargo says it's committed to safety and wellness at its workforce, and it's reviewing their own internal procedures after this event. Now, this is sad for a number of reasons. One of them, of course, is that nobody at her work recognized that she was dead for 4 days. I don't even know how that's possible at a normal job. Every single job I've ever worked, people would notice right away if I had died. I interact with people all the time. To have a job so depressing, where you're isolated so much into your own cubicle, where you don't do anything, no human interaction with anyone else, that they don't even notice if you die, is a tragedy. Nobody at that company, Wells Fargo, cares about her at all. They have no connection to her. She had no friends at her work. Otherwise, somebody would have known. The other sad part is nobody in her personal life recognized that she was dead, inactive, not calling or talking to anyone the entire weekend. Where's her family? Where are her friends? This is a sad situation altogether. Now, as I was looking over this story, and it's just unbelievable when I'm reading this to begin with, the biggest thing I was drawn to is how some jobs, like working at Wells Fargo, they don't care about you at all. These companies don't care about you at all. We should be doing everything we can to get people out of these jobs. If you're in a job like this, a dead-end one, where nobody cares about you at all, where you can literally die and nobody will notice, you got to work to a different situation. Get contacts, do something with your resume to get into a different job. That's not normal. Every job I've worked at, I know people there. I have relationships with them. I talk to people on the regular. They would be able to know if I had died. So that's not a normal situation. These companies that clearly don't care about their employees or have any interaction with them are not the only companies to be working for. There's much better ones out there. And it's a tragedy that she was 60 years old working at this job. Now moving on to a bit lighter of a note. Costco just recently increased their prices and they just went into effect. So as people are renewing their memberships, as they're re-signing up or they have their annual membership renewal, they're gonna be hit with the higher prices. Now Costco has been really good about this. They only increased the prices by like $5 to $10, depending on the plan. So this is a very soft incremental price increase, and it's the first one they've done in 7 years. So Costco has maintained their reputation for being consumer friendly. They're not jacking up prices like many other businesses. In fact, Costco has raised prices slower than the rate of inflation. So members should be very happy with their price increase. But what does this mean for Costco? Anytime a company that is a subscription company, like Costco, raises their prices, a few things happen. In subscription, churn and retention are two different ways of saying the same thing. Churn is how many people cancel a membership every single month. Retention is how many people maintain a membership every single year. So they're just two different sides of the same thing. Whenever Netflix increases prices, their churn rate goes up a little bit, meaning that a couple people choose to cancel their membership. It quickly goes back down afterwards. We saw that in their 2019 price increase. We saw it in their October 20th price increase, and we see it again in their January 2022 price increase. These are all impacting their churn rate. Now, over time, Netflix recovers from this, but raising prices does cause a higher amount of churn for a while. There's other different factors that can cause temporary churn, like the release of the movie Cuties, which had major boycotts. So other factors may overlap and cause different levels of churn, but you can almost isolate every price increase and see these different impacts of churn. Now with Costco, I don't have the churn rating of the company. I don't see how many members they're losing, but we do have the retention rate. The retention rate of Costco is something that they give out on the earnings call every single quarter. And I've tracked this all the way back into 2006. So we can see every single month what their retention rate was, which is how many people continue to use Costco the entire year. Going back to 2006, the retention rate was 86%. Went to 87% over the years. Into 2010, it bumped up to 88.8%, into the 90% in 2016. From 90%, it went up to 91% in 2019. In 2020, went up to 92%. And then the most recent quarter is 93%. So what I'll be tracking over the next year, after they did this price increase, is the next 4 quarters of churn. I want to see if this goes from 93% back down to 92% or 91% or 90%, or if it stays at 93%. Any type of decline in membership retention would mean that price increases do have an impact on Costco. So this will be a good test to see the pricing power and the value proposition of Costco to its customers. Now that's all for this episode. If you want to see more exclusive content, in-depth research on companies, and want access to Qualtrim.com, you can join the Patreon today. If you join it today, you'll get a free trial for the entire month of September. And of course, there's no risk to this membership. You're not signing any contracts. It's month by month. You have literally nothing to lose. So you can try it out for free at patreon.com/Joseph Carlson.